Sorry, someone was saying something? Okay, maybe not to me. Okay, so what we are trying to do is we are going to look at the first question on payback period. You know, we all know, of course, payback period is the first technique in investment appraisal. Okay, so that's what we're going to do. I'm going to read the question. I guess all of you have screenshot it. You should have it before you, but still, I'll read the question. The question reads: an asset costing £120,000 is to be depreciated over 10 years to a nil residual value. Profits after depreciation for the first 5 years are as follows. Okay, so year 1, year 2, up to year 5, these are the profits required. Calculate the payback period to the nearest month. Okay, so he's saying calculate the payback period to the nearest month. My question is, this 120,000, what is it? What is this 120,000? What is this 120,000, please, class?
It's the initial investment.
It's the initial investment, exactly. Yeah. The initial investment, okay? The cost of the capital. So that is the first outflow, okay? That's the first outflow. You know, as the Maninkas will say, this is the Jalan Siseo. You know, Jalan Siseo will always die, whether Jalan accepts or not. Okay? So this is what you're going to inject. Now you should make sure that all the inflows that will come will be able to, you'll be able to recoup this initial investment. Okay? So that's 120,000 is the initial investment. So what about these profits they're talking about? Profits after depreciation from year 1 to year 5. What profits are they? Are they accountant's profit or they are cash flows?
They are cash flows.
They are cash flows. Okay? They are cash flows. Are they cash flows or accountant's profit?
They are cash flows.
They are cash flows.
No. Repeat it again.
My question is, these profits that have been given, 12,000, 17,000, it says profit after depreciation. So after depreciating your assets, so that means after deducting depreciation, this is the profit that you get. Is it accountant's profit or is cash flow?
It is accountant's profit.
Accountant's profit.
Is accountant's profit. I hope you know what accountant's profit is. Accountant's profit is a notional profit. It's not a real profit. Meaning, if you prepare your financial statement, the last figure that comes under your income statement or your P&L doesn't mean it's in the bank account. I hope you all know that. I hope you all know that. That's why when we're preparing our financial statement, we prepare our statement of comprehensive income, we prepare our statement of financial position, and in addition to that, we prepare our cash flow, because cash is not equal to profit. By profit, I mean accountant's profit. Accountant's profit includes a lot of things that are non-cash. Depreciation, provisions, amortization, you know, just name them. There are lots of things, because accountant's profit is prepared using the accruals concept. Okay, just look at the sales that you recognize. When a business makes a credit sales, don't you recognize it in your income statement? You do, you recognize it. But does it mean you've already received the cash? No, you have not received the cash, but you still recognize it. So accountant's profit is different from cash flow. So what the question is telling us is the profits after depreciation for the 5 years are as follows. So that means these are profits that we have reduced depreciation from, which is the accountant's profit. Okay? Are you with me? Hello?
Yes, we have Mr. Tufano.
Okay. So these are profits after depreciation. So what should we do? What we need is cash flow. So they have reduced something that does not exist. So what's going to happen to our profit? It's going to reduce it. So what should we do? We should add that back. So the notional cost, notional meaning the non-existent cost, was deducted from our income to arrive at this profit. Now, if we want to get the actual cash, we add it back. Okay? I hope it's understood. Is it understood? Okay. I'll assume you understand it. Right.
No, Mr. Fofana, please come again.
Yes. What I'm trying to say is, if you read the question, it has given you some numbers from year 1 to year 5. And on the question, it says profit after depreciation for the first 5 years are as follows. What I'm saying is, these are income, okay, whereby they've reduced depreciation from them. We know depreciation is a non-cash item. Depreciation does not actually exist. You understand what I mean? Depreciation is only an allocation of purchase cost of fixed asset to each accounting period that benefits from its use. Why do we do that? Because we do that, we want to reduce our profit so that at the end of the useful life of the asset, we'll be able to kind of set aside some money, because set aside meaning, if you have that much profit, naturally it's going to be distributed to shareholders for usage. But if you reduce the profit by that amount, then that means at the end of the period, you will have some cash that you can use to replace the asset. So depreciation is a non-cash item. So non-cash item has been reduced from our cash item, we are assuming. So what should we do? We add it back to arrive at our cash flow. Is it clear now? Is it clear?
Yeah, it is. Thank you.
Good. Very good. So we're going to call the statement as PBP, payback period statement. Payback period statement. Okay. So we're going to call this area from, let's say, B15 workings. Okay. So that will be our workings. Okay. If you want, you can do it on a different page, but because this is a short question, we need our workings. Okay. So let's do our format. Let's lay our format. So you have here profit after depreciation. Profit after depreciation. Okay. I'm going to format this. I'm going to format it so that this can fit, within a smaller space, because we don't need all this. We don't need to expand all this, right? So I'm going to do it in such a way that we're going to wrap the text. Okay. So we need about 1, 2, 3, 4 columns. So 1, 2, 3, 4. So I go to format, wrap in text. Okay. And because they are numbers, we want to align them to the right. Okay. So we have the year, we have the profit after depreciation. Then we all agree that we have to add back depreciation, isn't it? So DEPRCN, I'm going to abbreviate it that way. And after adding the profit after depreciation back, what do you get? you get cash flow. Okay, you get cash flow. And then we're going to create another column called cum cash flow. It's not a requirement, but for ease of work, you can include it. So I just call it cum cash flow, meaning cumulative cash flow. Okay. So this is the way our formats are going to be. This will be in thousands. In order to allow the three thousands, you must do a single inverted comma, 000. Okay, we can copy this across. Sorry, because it's not a number, so it's just moving to the next one. So I just copy and then I just duplicate it here, paste. Okay. If I'm doing anything on Excel you don't understand, on spreadsheet that you don't understand, you can please call my attention, then I can explain it to you. Okay, so we have year 1 to year 5. Okay, so the best way to number in Excel, okay, is you do the first one, you do the second one, and then now you can click on the first and the second, then you just drag. If you keep dragging, then it will give you, okay, up to year 5. Okay, I'll show you what I mean. Because if you stop at the first one, if you drag, you can only get 1 in this. Okay, so there are 2 ways. You can either have a single quote, you have 1. Once you do that, then you can just replicate, it will number it for you, 1, 1, 1, like that. But the only problem with this is it is reading it as a text. So that's why it's aligning it to the left by default. If you look at it, look at inside the formula bar, is prefixed with a single quote, meaning it is a text. So the best way to do is do the first one, and then do the second one, and then you can highlight the 2 and then move on. Then it will give you up to where you need it. So the profit after depreciation have been given in the question. So we've expressed this into their thousands. So the first one will be 12. Okay, give me the second one. It's quick. Okay, 28.
17, 28,
37.
37,000.
And 8,000.
And 8,000.
So because they are all in their thousands, so we can just put the numbers without the thousand. Okay, so the depreciation, we're going to do our working for depreciation here. So how are we going to calculate depreciation? How do you find depreciation here? You've been given the cost of the asset, and then it says it has a nil scrap value. Okay? Nil scrap value, and the asset is going to be used for 5 years. So what is your depreciation? Sorry, no, it's over 10 years. Sorry, the asset is going to be used over 10 years. So depreciation we know is cost minus what? Depreciation uses straight line method. Cost minus?
Cost minus useful life.
Yeah, okay.
Cost minus scrap.
Yeah, it's the same.
Cost minus scrap.
Cost minus useful life.
All over useful life.
Okay. Cost minus scrap divided by the useful life.
Useful life.
Okay. So it's the cost minus scrap value all over useful life. So we can do that. What's our cost? What's our cost?
120,000.
120,000 minus what's our scrap value?
The scrap value is nil.
Nil, okay, which is 0. So we should make sure we follow both mass. We should follow both mass. So we put this in bracket.
Yeah.
We should put this
in bracket.
Okay. We follow both
divide
mass.
by 10.
Divide by 10. So that gives us what? 12,000. So we can format this. We come here, number format. We choose the first one. but then we remove the two decimal places. Okay, so now what do we do? This is depreciation using straight line. They don't have to tell you straight line because it tells you that it's going to be depreciated over 10 years and the value is nil. So naturally, you know that it's a straight line method. Okay, so we're going to bring the depreciation here for all. So what do? We say equals. We click on depreciation. Okay, after doing that, what do? Enter. We copy here. Hello, Demba Baji, Demba.
Mr. Fupa,
Yes, Hadi. What do we do?
if you happen to just like, if we equate to this, then how about the 1,000 here? The 1,000 that we already have in the first
Yes.
column.
Yes. So what should we do?
Yes.
What should we do? This is a good one. Good.
So
So we put this in another bracket. Okay, we put this in another bracket and we divide it by 1,000, isn't it? So now we have 12. Okay, thank you so much, Hadi, for putting that to our notice. So what we do is we put this in another bracket and divide by 1,000 so that we can have our 12. So now, how do we bring this 12 here? Is we say equals,
and then click at then the cell D16.
Okay, I click on D16. D16. Then I enter.
Enter.
Okay, then.
Yeah.
So what about the others? I think they are all 12. So what should I do?
No, but then you have to
All is 12. All should be 12.
Okay, so what do I do next?
You drag and
Huh?
You replicate.
I'm coming to Salo.
Okay, how do I replicate? I just replicate here. But it's giving me nothing. I replicated just like you asked me to do. Look at it. The formula is there, but it's giving me nothing.
What if you copy and
Hello?
paste?
Someone was suggesting.
Click on the bottom right corner of the cell. Where the
Philomene, you say I should click on the
bottom
yes,
right,
on the bottom. Yes, I've done that, Philomene. What do I do next?
then you drag.
Then I drag.
Yes.
Okay, yes. Now I've dragged Philomene, but it's giving me empty space, Philomene.
Okay, what if, Mr. Fofana, what if you copy and paste off? That will take time.
Okay, let me do. Just wait. I'll say copy, and I'll paste, just like somebody said about paste. But if I do that, also, it's giving me nothing.
Then Mr. Fofana, it is best known to you then.
Demba?
Can you make it an absolute value?
Someone is talking. Good. Demba, are you working?
No, sir. I have been just
That's a
playing
good one.
previous videos. That's why.
Okay, good. So you are following previous videos. I like that. Good. So you should make it absolute values. You should make it, sorry, not absolute value, absolute cell reference. Okay? Because the problem with Excel is if I do one formula, I copied this from here. If I come down once, okay, look at what's going to happen. Look at it. It is copying from this cell, not from the previous one. Can you see? Can you see?
Yes, we can see.
Yes. If I move here, okay, I press my F to look at it. It's doing the next one. So because Excel formulas, if you replicate them or if you copy and paste them, it moves as its source moves. The source is from here. So if you move one step here, it's also going to move another step here. So to avoid that, you make the cell reference absolute. Okay? So I'll show you how to make the cell reference absolute. So you come here. Okay, I just take that. So if we want to copy this here, we say equals. When we click on D16, before we move, before we do anything, we press F4. Okay. So if we press F4, it's going to give us two $signs. A $sign before D and a $sign before 16. Okay? So what that means is the cell is absolute, meaning even if you copy this to anywhere, it can only be D16 and nothing else. If F4 is not working for your, well, you know, depending on the keyboard, sometimes your F4s can be hiding somewhere. But if in case it's not working, you can just use the normal $sign. It will work as well. So once you enter, now, Philomen, look at this. I replicate, look at it. I'm getting 12 all through R. Can you see? Can you see? Please make sure you learn this new skill. Okay? This is really good.
Yes.
And surprisingly, not a lot of people know that, in fact, you can have a cell reference that you can make absolute. Actually, there are three kinds of cell references. You have the relative cell reference, which by default, all cell references are. Relative means it's related to the order. If you move once, it's going to move with you. Absolute means it's fixed to a particular something by two $signs. And then the mixed is part absolute, part relative. So for example, if I come here, let's say I want the D to be fixed, I can put the $sign before D, but then that of the rows, I want it to change, then there will be no $sign before 16, and then as I copy, that will follow me. That's what you call the mixed cell reference. Okay? So the next column where it says cash flow, what do we do? What do we do to get the cash flow? Do we add back the depreciation, or we deduct the depreciation from the depreciation from the profit after depreciation? Do we deduct? Do we?
No, we add the profit after depreciation plus the depreciation. We add it.
We add it back. Excellent. We add it back. So if you have to add back, is the simple sum formula. Say equals. You click on C6 plus
D6.
If you want, you can do the equal sum function, but since these are only two, you can just do a simple plus function. So this one, we replicate. So once we replicate, we got all of that. Then now, we're going to get our cumulative. How do we calculate our cumulative? Okay, the first one will be here. And then the second one will be the previous plus the current. We enter. And we replicate. Okay, so if we have our cumulative cash flow, it should start from 24 and end in 162. I hope you know how I did that.
Yes.
Excellent. Okay, so now we have our cumulative cash flow. Okay, now it will be easy for us to calculate our payback period. So what is our payback period? Our payback period. What's our payback period? We know our payback period is the number of years and months it takes for us to recoup our initial outlay. What is our initial outlay in this question?
120,000.
120,000 is our initial outlay. So, which year? My first question is, which year are we going to recoup this 120,000? In which year?
Year 4.
Year 4. Very good. Year 4. Because when you look at the cumulative values, in year 4, it will be 142. Naturally, it cannot be year 3 because year 3 cumulatively is only 93,000. 93,000 is less than 120,000. But in year 4, cumulatively is 142. So that means it's going to lie somewhere in between year 4. So now you have to calculate the month. So the first thing you know is you know that the payback period will be in year 4 without doing any calculation. It will be done in year 4. Okay? So which month in year 4? How many months? So the payback period will be 4 years. 4 years and how many months? How are we going to calculate our months? How are we going to calculate our months? Okay, the way we're going to calculate our month is easy. We know that our payback period cumulatively will be in year 4, but we don't know how many months into year 4. Okay, we know up to here, we've got what? 93,000. Okay, so what we do is, we do our formula here. We required 120,000, okay, minus 93,000, okay, minus 93,000 up to year 3, isn't it? So now what do? We put this in bracket just to obey board mass. Now what do we do? If we deduct,
2 years or 4 years?
sorry?
Mr. Fofana,
Yes?
is it 2 years or 4 years?
Is it 3 years or 4 years?
It's going to be 4 years some months. I think after that you have to divide it by the next column, which is the 142, if I can recall right.
Someone has made a very good sense. Someone was asking, is it 3 years or 4 years? Very right. It's not yet 4 years because it's going to pay back in year 4. So the payback period is what we are calculating. Very good. So not all of you are sleeping. So it's going to be 3 years plus how many months? Actually, it's going to pay back in year 4. So that means it's not gonna take the whole of year 4. So the payback will be 3 years plus some months. Those some months will be in year 4. Okay? So to get those 2 months, yes, that was a good one. Who said that? Was that Binta?
It should be 3 years, 3 years plus 7 months.
Yeah. So how do we calculate the 7 months? We say 120,000 minus 93,000. We divide all that by what? I hope you people are understanding me.
142,000.
Huh?
We divided by 49.
No. 142,000. It's 142,000 we have to divide. Hello?
No, my flash needed.
Sorry? Why do you say 49,000, not 142,000? Why do you say 49,000?
Papa, I think this will be 49,000.
Why? Why should it be 49,000? You have to convince me. Why?
I think it is in between 3 years to 4 years.
Okay. Yes, that is correct. And continue. It's very simple. You are right. It should be divided by 49,000. The reason is we are going to pay back somewhere in year 4. And the cash flow for year 4 is not 142,000, mind you, but 49,000. 142,000 is the cumulative cash flow up to year 4. Okay? So when you are doing your cumulative thing, you have to be careful because some students, what they do is they will take 142,000. They'll be tempted to take 142,000. Okay, so it should be divided by 49,000. Okay, so we put another bracket so that we multiply all that by 12 to give us our month, which is 6.6. If we round it up, that will give us 7 months. Okay, so it's 3 years, 7 months. So our payback period is 3 years, 7 months. Is that clear? Okay. So our payback period is 3 years, 7 months. And of course, if you click on it, you'll see the formula. The formula is 120,000, which is the total initial outlay, less 93,000. 93,000 is the cumulative cash flow up to year 3. Okay. All that divided by the cash flow for year 4, which is 49,000, because we want to get a proportion of the cash flow of year 4. So by deducting 120,000 from 93,000 will give you that element that you need in year 4. Okay? And that element, of course, divided by the total amount. You will not need all these 49,000, but you will need that part. So the 93 and 120, that will be what? 7 plus 20, 27. So you'll need 27,000 from the 49,000. So if you express 27,000 over 49,000, that will give you 7 months if you convert that to months. So that's why we say this minus that divided by 49,000 multiplied by 12, meaning 12 months. Okay, is that clear, everybody? Shall we move? We have to do accounting rate of return today as well, so that we stop there. Then on Saturday we'll do the DCF techniques. Yeah.
So, Mr. Fofana, are we able to finish accounting rate of return?
Yes, we'll do accounting rate of return today. Okay, we're going to do it today. So that on Saturday, we will do our DCF techniques. Okay. So, there's a small question on, I think it's about, oh, no other question on this. No other questions on this here, on payback period. So that's it. That's it for payback period. Actually, payback period is very, very simple. Nobody will bring it on its own in exams. Nobody. Maybe when you are at primary school, actually. Maybe when you are at primary school, not at university. Okay? So don't expect only payback to come on its own. It's too cheap.